This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 2, 2026, and this is the New York session. Now, let's get into it. The U.S. labor market just delivered a severe miss, printing plus 57,000 jobs against expectations of 110,000. That single data point has triggered a broad sell-off in the greenback, pushing the Fear and Greed Index down to 14 out of 100, a deep state of fear, even as volatility measures remain surprisingly subdued. Looking ahead, the market's attention turns to domestic labor data. Today, we receive the weekly jobless claims report. This is the next pulse check on whether the soft hiring number in non-farm payrolls represents a temporary blip or a structural shift. Next week, the Reserve Bank of Australia makes its rate decision on July 7th. For our Aussie crosses, particularly Aussie dollar and Aussie yen, that meeting will set the tone for carry trade viability in a risk-off environment.
And remember, on July 8th, we'll get the GDP Now estimate, which could either validate this slowdown narrative or surprise us with revisionist growth data.
Here is the snapshot as of 9:30 a.m. Eastern Time. We are seeing a clear rotation out of the US dollar. Spot gold is up 0.92% to 4,072.05, acting as the primary beneficiary of the flight to safety. Meanwhile, sterling is showing relative strength, with cable climbing 0.08% to 1.3290. Conversely, the dollar index is weakening across the board. Dollar yen is down 0.09% to 162.403, and dollar Swiss is down 0.08% to 0.80858. The broader message from the director's brief is that we are witnessing a dislocation where employment data is soft, but inflation remains sticky, creating a complex backdrop for currency valuation. Let's dig into the headlines driving this move. First, the headline act. U.S. June non-farm payrolls came in at plus 57,000 versus a plus 110,000 expectation. This was the spark for today's volatility. That miss is the core of the paradox. You have a labor market shedding ground, yet the Federal Reserve is staring down CPI at 4.17%, and core PCE at 3.41%. The market is currently trying to reconcile soft labor with hard inflation, which is why we're seeing that defensive pivot into gold rather than a simple dovish rally. Second, Fed Governor Daly noted that in the U.S., there is exceedingly strong investment growth.
That comment creates a divergence. While the non-farm payrolls data screams slowdown, Daly's focus on investment growth suggests the Fed isn't looking solely at payroll counts. From a flow perspective, this means leveraged funds aren't just dumping dollar because of jobs. They're dumping it because they believe the quality of the remaining demand is shifting. They are front-running a scenario where investment drives asset prices even if wage growth stalls.
Third, headlines highlight that the long-term look at U.S. labor force participation is ugly and getting worse.
That is the hidden risk flag. Everyone is focused on the headline non-farm payrolls miss, but if participation is collapsing, the 21,500 initial jobless claims, while better than the 22,000 estimate, might be masking a deteriorating underlying trend. This structural weakness is what supports the fearful sentiment score of 14, even though the VIX has only moved to 16.45. The market is scared, but the volatility index hasn't caught up yet.
Let's start with the big mover, gold. It is sitting at 4,072.05, up nearly 1%. Grid, walk us through the technical structure here.
We are looking at a clear higher-low structure. Price closed at 4,072.05, which is significantly above the 5-day low of 3,942.2, and today's intraday dip to 4,030.82. The technical picture shows that spot participants are aggressively buying the dip. The consolidation zone around 4,111.09, the 5-day high, is now being tested. Support has shifted from the old low to the $4,030 region.
So, buyers are defending 4,030.
Exactly, and this aligns with the flow data. While equities might be shaky, we're seeing institutional accumulation in hard assets. The leverage isn't coming from speculative retail traders chasing the pump. It's coming from asset managers rotating out of fiat. This isn't a momentum trade, it's a portfolio hedge. The flow is consistent with the safe haven bid mentioned in the briefing.
But SPECTER, you flagged a risk here. Is this calm justified?
It's deceptive. You have gold rallying to 4,072 while the VIX is languishing at 16.45. That disconnect is the danger. If the VIX breaks above 20.72, the upper bound of its 5-day range, that quietude shatters. Right now, gold is pricing in a smooth transition to lower real rates, but if the labor force participation data triggers a panic about stagflation, the VIX spike could cause a liquidity crunch that drags gold down temporarily, regardless of the fundamentals.
Shifting gears to sterling cable. It's up 0.08% to 1.3290, right at the edge of its 5-day high of 1.3295.
Technically, this is a breakout attempt. We've swept through the mid-range consolidation area around 1.3250 with velocity. The pair is within 5 pips of its 5-day high. If we hold above 1.3295, the path opens toward the psychological barrier of 1.3300. However, the risk is a mean reversion pullback to the 1.325 area if buyers exhaust themselves here.
What's supporting this move? Is it purely dollar weakness?
No, it's relative strength. Look at the COT data. Leveraged funds are moderately bullish on pound, holding a net long of 7,567 contracts. More importantly, unlike the dollar, which is seeing speculative exhaustion, pound isn't facing the same overcrowded short squeeze dynamics. UK labor data provided a counter-narrative to the US non-farm payrolls miss. So this isn't just buying the dollar weakness. It's selling the US recovery narrative.
I'd challenge that characterization slightly. The UK resilience helps, but don't ignore the yield curve stress. The 10-year to 2-year spread is flat at plus 0.31 basis points. That flat curve applies pressure to all currencies, including pound. If the US curves flatten further, it drags global rates down, which can cap pound's upside even if the pound is relatively stronger. The ceiling isn't just technical resistance, it's macroeconomic reality. Let's talk about the most crowded trade in the book, the Japanese yen. Dollar-yen is at 162.403, down 0.09%.
This is the biggest positional risk in the market. Leveraged funds hold a net short of minus 97,922 yen contracts. That is a massive concentration. Week over week, they added almost 100,000 contracts to this short. It is one of the most crowded directional bets in the cycle. Every tick lower in dollar-yen increases margin pressure on those shorts.
So technically, where are we?
Dollar-yen is trading near the bottom of its 5-day range, which started at 161.721. We are compressing tightly against support. If the 161.72 level holds, we might see a bounce, but given the short squeeze mechanics CIPHER outlined, a break below that low could trigger rapid covering. The volume signal on the drop from 162.8395 down to 162.403 suggests that selling pressure is intensifying, not exhausting.
And here is the trap. Everyone assumes the short squeeze happens on the downside. But consider the ugly labor force participation data I mentioned earlier. If next week's jobless claims come in worse than 22,000, it confirms structural decay. Paradoxically, that could cause a rebound in the dollar if the market panics about a loss of control, triggering a short squeeze higher. The VIX is at 16.45. If that VIX spikes due to unexpected dollar strength, those minus 97,000 contracts become a liability trap instantly.
Finally, let's look at the Australian dollar, Aussie dollar. It's at 0.68942, up 0.06%.
Technically, we are in the middle of the 5-day range, which spans from 0.68653 to 0.69300. There is no clean breakout here. We are consolidating.
Yet CIPHER, the positioning is strongly bullish.
Yes, net long positions stand at plus 39,111 contracts. That is strongly bullish leverage. But Grid is right, we aren't seeing the price confirmation yet. We have the money in, but the momentum isn't there.
This is the unsustainable part. You have commodity-linked bullish positioning in a fearful environment where the fear and greed index is at 14. Usually, when fear is this high, capital flees beta. Aussie is a beta currency. Unless equity markets stabilize immediately, that plus 39,000 long position is exposed. The data shows a disconnect. The flows say buy the carry, but the sentiment says hide in cash. Until price breaks above 0.69300, those longs are waiting for a lifeline that hasn't arrived.
So, Aussie is vulnerable until proven otherwise.
Precisely. And remember, dollar CAD is at 17.5265. Canadian dollar is also showing heavily bearish CFTC net positioning at minus 83,377. The entire commodity complex is facing a headwind. Without a VIX breakout that signals renewed risk-on appetite, Aussie and Canadian dollar are just floating in a sea of dollar weakness without their own wind behind them.
To tie this together, Grid identified that gold is defending higher lows at 4,030, validating the institutional safe haven bid. But CIPHER reminded us that the yen short squeeze at minus 97,000 contracts is the most fragile element in this structure. It requires continuous dollar weakness to survive. Pulse highlighted that the macro backdrop of a flat yield curve at plus 0.31 spreads caps the upside for sterling and Aussie, preventing a clean breakout despite the non-farm payrolls miss. The market is currently pricing in dollar fatigue, but the low VIX at 16.45 suggests that fatigued dollar can snap back violently if the labor data disappoints further. The trade is not long dollar, but it is certainly not short dollar blindly either. It is a war between non-farm payrolls disappointment and sticky inflation data.
Key takeaways from this session. First, gold is holding firm above 4,030, supported by institutional flows despite a surprisingly low VIX. Second, cable is testing its 5-day high of 1.3295, driven by relative UK labor resilience rather than just dollar weakness. Third, the dollar-yen short squeeze at minus 97,000 contracts is a ticking time bomb. Any stabilization in the dollar could trigger rapid volatility. Tomorrow, watch the weekly jobless claims. If they exceed 22,000, expect that VIX to wake up. Thank you for listening to the ShadowQuant Forex edition. Stay disciplined. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.